Meet my friend Eddie. He was sitting in a life insurance class for hours when the instructor looked at him and asked him to define insurance. Now, Eddie sank in his chair because he had no idea how to put it into words. So let's help Eddie out and start with the basics. Insurance could be summed up by two words: spreading risk. Insurance takes the risks associated with many individuals, combines them, and then spreads the combined risk over the group. Now, the idea of insurance is not new. It dates back as far as the 15th century. Consider the following example of a rudimentary form of insurance that may have taken place back then. Let's assume that 10 merchants needed to ship their inventory over treacherous waters where the risk of a ship sinking is a very real possibility. Now, each boat can hold 10 shipping containers. Therefore, if a merchant's ship sank, he would lose all of his containers. Now, Merchant Arnold came up with an idea. Why don't we spread our containers over each other's boats? That way, if one ship sinks, the most anybody can lose is one container. Now, all of the other merchants thought it was a fantastic idea, and each tossed Arnold a few precious stones for making the arrangements, kind of like a premium. Well, when it comes to life insurance today, insurance spreads the risk among people within the same risk class. Clearly, the risk of a 40-year-old man dying this year is obviously very different from the risk of a 70-year-old woman dying this year, and therefore they would not be in the same risk class. When approving life insurance, many factors are considered, such as age, gender, personal and family health history, smoking status, employment, etc. Now, there are two ways to quantify the risk of death, and you could be asked this on the exam, so take note. They are, number one, life expectancy. For example, perhaps another 20 years. And number two, the probability of death in a given year. For example, perhaps 1 in 1,000. Now, most students taking this course already have some knowledge in terms of what life insurance is. Therefore, I'm going to summarize life insurance in one sentence, go over an example, and then begin to build on that knowledge by discussing the various types of insurance policies available in the marketplace. Now, life insurance can be summarized as follows. If the life insured dies from a covered cause while the policy is in force, a tax-free benefit is payable to the beneficiary of the policy. Now, if the term beneficiary is new to you, don't worry. It's just a fancy word for the person the policyholder selected to receive the eventual death benefit. Let's look at an example. Brett and Sarah are newly married with an infant daughter named Mandy. Now, Brett earns $120,000 per year, which allows them to enjoy a pretty nice lifestyle. Now, they worked hard to pay off their student loans quickly, and as a result, they have no debt, but they also have limited assets. Brett and Sarah have reached the decision that she will stay home to take care of Mandy full time. They worry, though, what would happen if Brett were to die unexpectedly and his income stops? Well, life insurance is the answer. They purchased a life insurance policy that upon Brett's death would pay a tax-free death benefit of $2 million. This lump sum of money could then be invested to replace Brett's income. There are 4 ways to deal with certain risks. Let's look at a non-life insurance example. Well, Harold just used his entire life savings to purchase a brand new sports car. He bought the car because he loves speed, but is concerned about the financial impact that may arise if he has a major accident in the car. Now, Harold has 4 options in managing the risk. They are, number 1, risk avoidance. Harold could simply choose not to drive the car and leave it in his garage just for show. Number 2, risk reduction. Harold could reduce the risk by always respecting the posted speed limits and road signs. Number 3, risk retention. Harold could elect to retain the risk or self-insure. If he totals the car, he will no longer have the car and can take the bus. And number 4, risk transfer. Harold could transfer the risk to an insurance company by purchasing automobile insurance that covers collision. Now, risk transfer is also referred to as risk sharing. Now, obviously, most of this course will focus on the ways to transfer risks to an insurance company.